Welcome to this explainer. If you're managing operations, accounting, or just trying to wrap your head around UAE VAT, you might think tax compliance is just, well, a chore about getting your numbers right. But actually, it's this incredibly fascinating geographic puzzle. Tax compliance isn't just about what you sell or how much you sell it for, it's intimately tied to exactly where that transaction happens, in the eyes of the law. So let's crack this puzzle together and see how these rules actually work in practice. Okay, let's dive into this. Here is our roadmap. We'll start by defining what place of supply actually means, break down the rules for physical goods, tackle imports and GCC trade, then flip the script to intangible services and their exceptions, before wrapping up with the reverse charge rule. Don't worry, we have a clear, logical map to navigate this whole tax rulebook. So, starting with Section 1, what is place of supply? Why does the location matter just as much as the transaction itself? Fundamentally, the place of supply is the exact location where a transaction is considered to have occurred for VAT purposes. Notice that specific phrasing there, considered to have occurred. The law actually has its own unique way of seeing where a sale happens. And spoiler alert, it isn't always where your cash register sits or where your invoice is generated. Understanding this core concept is absolutely crucial. It's the bedrock of getting your UAE VAT right. Now, before we get deep into the weeds, we have to understand what I like to call the Great Divide. Basically, physical goods and invisible services follow entirely different foundational logic. For goods, the place of supply is tied directly to the physical location of the items when the supply occurs. But for services, it's generally tied to where the supplier is established. Keep this fundamental split in mind because it dictates literally everything we are about to cover. All right, moving to Section 2. Let's look at the rules for physical goods, the physical, tangible items your business actually moves. The absolute simplest scenario is a domestic supply. If the delivery is made entirely within the state, the place of supply is the UAE. To bring this to life, just imagine a furniture dealer. If that dealer supplies a beautiful sofa set from their warehouse in Abu Dhabi directly to a customer's living room in Sharjah, that entire journey happens within the country. So the place of supply is unequivocally the UAE. Very simple, super straightforward. But what happens when those goods leave the region entirely? Let's say Company A is based in the UAE, and they supply heavy machinery to a client all the way over in London. They declare the finished goods for export right here in the UAE. Because the goods are dispatched from the UAE to a non-GCC member state, the supply officially happens in the UAE. The point of origin dictates the tax jurisdiction here. On to Section 3, imports and GCC trade. This is where we cross borders within the Gulf region, and things get slightly more complex. When goods are transported from the UAE to another GCC member state, the rules change entirely depending on who is buying. If your customer is a VAT-registered taxable person, the destination rules. For example, if a UAE supplier sells a massive bulk order of confectionaries to a VAT-registered supermarket in Saudi Arabia, the place of supply is the KSA. The destination dictates the rules, and the customer handles the VAT on their end. And this brilliantly illustrates the catch for unregistered customers, because here, it all comes down to export thresholds. If your total exports to that destination state are below their mandatory registration threshold, the place of supply remains the UAE, and UAE VAT applies. But, and this is a big but, if you exceed that threshold, the place of supply shifts to the destination state, and VAT must be paid there. It's a crucial if-then scenario that means you have to carefully track those export volumes. Now, let's look at the exact reverse, bringing goods in. For imported goods, the place of supply is the country where the goods are declared for consumption. Say a business owner in Abu Dhabi imports a shipment of luxury perfumes from the UK. Because they are declared for consumption here in the UAE, the place of supply is Abu Dhabi. Okay, here is a tricky scenario that catches so many businesses off guard. It's called the deemed supply trap. Imagine you import goods into the UAE. You pay the import VAT and you recover it, fully expecting those goods to stay and be sold right here in the UAE market. But, plans change and you end up re-exporting those goods to another GCC state. Well, the law steps in right here. This transfer is treated as a deemed supply subject to VAT. Because the goods didn't stay in the UAE like you originally declared, you actually need to repay that import VAT you previously recovered. It's a fascinating, strict mechanism just to ensure VAT is paid where the final consumption actually happens. All right, Section 4. Let's cross the border from the physical world into the invisible world of supplying intangible services. We are completely flipping the logic here.
We can really anchor our understanding of services on this one single powerful rule. The basic rule, where the supplier has their place of residence. For services, it is fundamentally about the who and where they live, not the what or where it goes. If a taxable supplier resides in the UAE, the service they provide generally has a UAE place of supply. It's that straightforward.
But wait, Section 5, Special Service Exceptions. As we all know, tax law absolutely loves its exceptions, so let's rapid fire through the overrides to that basic residency rule.
So, the crucial point is that for a specific set of industries, that default residency rule just goes right out the window. If a non-resident provides a service to a VAT-registered UAE resident, the place is the UAE. For installation services, it's where the installation actually happens. Real estate services are tied strictly to where the physical property sits on the earth. Hotel, restaurant, cultural, or sports services, it's right where the service is physically performed. Telecom and electronic services are based on where the service is actually used or received. And passenger transport is the exact location where the transportation begins. The logic here drastically shifts from where the supplier lives to where the service is tangibly experienced or rooted.
And finally, Section 6, the reverse charge rule. Think of this as the vital safety net for VAT-registered entities bringing things into the country.
This reverse charge mechanism applies whenever a VAT-registered person imports a taxable good or service into the UAE. Now, normally, a supplier charges VAT and pays it to the government, right? But with international inbound trade, the foreign supplier isn't registered in the UAE. So this mechanism brilliantly shifts the responsibility. The UAE-based VAT-registered buyer accounts for the VAT on behalf of the supplier. It's an accounting maneuver that makes sure the tax system works smoothly, without the government trying to chase down foreign entities all over the globe. So we've covered the great divide between goods and services, the tricky thresholds of GCC trade, the deemed supply traps, and a whole myriad of service exceptions, which leaves us with this provocative question. In the eyes of the law, are you absolutely certain where your last transaction happened? After seeing just how nuanced the place of supply can be, I highly encourage you to go look at your own supply chain. Review your books with this geographic puzzle in mind. Thanks for joining me for this explainer, and keep learning.